Welcome to the debate. Welcome to the research desk. I want you to imagine just for a second that it is March of the year 2000.
The absolute peak of the frenzy.
Exactly, the absolute peak. Your neighbor, who, let's be honest, knows absolutely nothing about cash flow analysis or discount rates, just quit their job because their shares in this networking company called Cisco, they just doubled in a single month.
Right, and they're probably telling you how much of an idiot you are for not buying in.
Oh, they definitely are. And every fiber of your biological hardware, millions of years of evolutionary psychology is just screaming at you to join the herd, to buy in, to participate in this massive wealth creation. But you have a piece of paper on your desk.
A rigid checklist, presumably.
Yes, a rigid mathematical framework. And it tells you that you are standing at the very edge of a cliff. It tells you the market has reached a mathematical extreme and a violent reversal is imminent.
So the question is, do you trust the math or do you trust the madness of the crowd?
Exactly. Today, we are examining a question that cuts straight to the philosophical core of capital allocation, across the board. Can a systematic framework truly tame market chaos? Or, does real-world complexity render such checklists entirely futile?
And look, it is a vitally important question. We are navigating an era right now that is defined by AI-driven volatility, unprecedented geopolitical shocks, and just rapid technological disruption. Understanding market turning points is literally an existential challenge.
It really is. It's not just an academic exercise.
No, not at all. We don't debate this just for the sake of intellectual sparring. Capital preservation, and honestly, the mathematical reality of compound growth depend entirely on how we navigate these violent market transitions. Markets are not linear trends that just neatly extend to the horizon. They act as nonlinear pendulums.
They do, and that brings us to the core of my perspective today. I hold that while markets are intensely complex and, yes, periodically chaotic, a disciplined, systematic framework can impose necessary structure on that chaos.
A specific framework, right?
Yes, specifically the extreme reversal theory, or ERT. By utilizing its rigorous five-step process, it forces us to mitigate the catastrophic cognitive biases that destroy wealth at market extremes.
But you're assuming the extremes can be perfectly measured.
I am. By deliberately measuring empirical extremes across multiple dimensions, we can reliably identify turning points. A system doesn't have to be clairvoyant, It doesn't need a crystal ball. It merely has to be disciplined, objective, and deeply grounded in historical data.
Well, I approach this from a very different vantage point. Markets are fundamentally nonlinear, complex adaptive systems. Deterministic checklists fail, and honestly, they often fail spectacularly.
Spectacularly? I think that's a bit of an exaggeration.
It's really not. They fail because the underlying structure of the market is in a constant state of mutation. What constitutes an extreme valuation or an extreme sentiment reading shifts constantly across different macroeconomic regimes.
But the math of valuation remains the math.
Sure, but catalysts are emergent phenomena. They are not clean, predictable variables that you can just slot neatly into a rigid 20-point scoring system. Trying to map a chaotic, shifting ecosystem with a static ruler is a recipe for false confidence and ultimately catastrophic capital destruction.
I see why you think that. I really do. But let me give you a different perspective on what a system actually is. It is not a static ruler. It is a boundary metric. But before we get into the structural friction between our philosophies, I think it's crucial to establish where our intellectual frameworks actually align.
Fair enough. Common ground is always a good starting point.
Right. Because regardless of whether you are a systematic quant or a discretionary macro trader, we both agree on the historical reality that markets are fundamentally cyclical.
No, absolutely. We do. No serious market observer denies the existence of cycles. Every asset, without exception, travels through distinct, recognizable phases.
Exactly. You get the crowded tops.
Where absolute euphoria replaces fundamental analysis, yes. And then we see the decline relays, where the initial shock of a sell-off gives way to a grinding multi-month devaluation.
Which then leads straight into the valley of despair.
Right, characterized by total capitulation and universal pessimism. And finally, we see the recovery uptrends. If we look at Japan's 1989 bubble, It provides an undeniable textbook illustration of this exact pattern.
Yes, let's break down exactly what happened in Japan in 1989 because it perfectly illustrates the psychology of a crowded top. The Nikkei reached valuation multiples that were just fundamentally unmoored from reality.
Precisely. I mean, they required mathematically impossible future growth rates just to justify the prices being paid. But what makes it fascinating is the narrative that supported those multiples.
The new paradigm thinking?
Exactly. It was not just blind speculation. It was a deeply ingrained belief that the Japanese economic model had permanently defeated the traditional business cycle. Investors pointed to the kairitsu, the corporate cross-holding structures, and the deeply interlinked real estate market as proof.
Proof that the downside had been structurally eliminated.
Right. The narrative was literally that the land under the Imperial Palace in Tokyo was supposedly worth more than all the real estate in California. That was the actual narrative.
And when that narrative broke, the subsequent multi-decade decline into a valley of despair perfectly mapped the life cycle of an asset bubble. The 2008 financial crisis provides another perfect historical citation for this pattern, but with a different mechanism.
A completely different mechanism, yeah.
The crowded top in the housing market and mortgage-backed securities was built on a different illusion, the illusion of flawless, mathematically engineered risk distribution.
Yes. The belief that by slicing subprime mortgages into tranches and securing AAA ratings from credit agencies, the localized risk of a homeowner defaulting in Nevada could be completely neutralized globally.
Which is absurd in hindsight.
Totally absurd. It was the ultimate linear extrapolation. The market assumed that because housing prices on a national level had never simultaneously declined in modern U.S. history, they just never would.
Right. And when the cycle turned, the decline relay was swift, it was brutal, and it led to a profound valley of despair across global equities. Which brings us to a shared principle. High prices inevitably self-correct through demand destruction. When capital becomes too expensive or the fundamental utility of an asset is completely dwarfed by the cost to carry it, the demand naturally evaporates. We also agree perfectly that universal bullishness signals maximum risk.
We do, because of the mechanics of capital flow. When every marginal buyer has already allocated their capital to a bullish thesis, there is simply no one left to drive the price higher.
The buying power is exhausted.
Exactly. At that point, the slightest change in liquidity or the tiniest fracture in the narrative causes a massively disproportionate downward repricing. And this is why risk management is non-negotiable.
Right. And part of that risk management is recognizing that policy floors do not guarantee market floors. Central bank interventions, massive fiscal stimulus, zero interest rate policies.
They can delay the cycle, but they cannot repeal it.
Exactly. The belief that policymakers can permanently suspend the business cycle is exactly the kind of linear extrapolation that traps investors at the absolute top. Linear extrapolation is always a trap because it assumes the specific conditions of the present moment will extend indefinitely into the future.
Completely ignoring the self-correcting mechanisms inherent in any complex system.
Exactly. So, we have established a robust baseline. We perfectly agree that extremes exist. We agree that they matter immensely. We agree that markets are inherently cyclical, and that linear extrapolation is a psychological trap.
We are in lockstep on all of that.
Great. So here is my challenge to you. If we agree on all of that, why do you resist the attempt to systematically measure those extremes?
Because measurement implies a false certainty.
But if we know these cyclical phases happen, and we know human psychology consistently, repeatedly fails at identifying them in real time because we are blinded by greed or fear, isn't an imperfect system objectively better than relying on raw intuition? Imposing a structural measurement seems not just logical, but strictly necessary for survival.
I hear you. But I resist the attempt to systematically measure them because the act of measurement implies a static baseline that simply does not exist in financial markets.
I disagree that it's completely static.
But an imperfect system is not necessarily better than intuition if that system creates a false sense of security. When you build a rigid, quantitative system to measure an extreme, you are very often measuring the ghosts of past cycles rather than the living reality of the current one. You are fighting the last war.
I think that
fundamentally misunderstands the framework.
Well, I want to hear you defend the actual mechanics of this framework. Walk me through how extreme reversal theory actually operationalizes this in the real world.
Gladly. Let's look at the actual architecture. Extreme reversal theory, or ERT, provides a rigorous 5-step system designed to replace emotion with empirical observation. Step 1 is cycle positioning.
Okay.
The goal here is simple but profound. By mathematically mapping assets to their current cyclical phases, investors can systematically avoid chasing crowded trades. Let's go back to the dot-com bubble for a pristine historical example.
Let's do it.
In March 2000, Cisco's price-to-earnings ratio peaked at approximately 100 times earnings. It was universally perceived as the fundamental, untouchable backbone of the new internet economy.
Right. Because the prevailing narrative was that the internet required an infinite amount of physical plumbing to function. Routers, switches, fiber optics, and Cisco was essentially the only plumber in town.
Yep,
The market priced it as if its growth curve would accelerate forever.
exactly. But let's look at the mechanics of a 100 multiple. If you buy a company at 100 times its earnings, and those earnings never grow, it will take you 100 years to earn your money back.
Which is mathematically absurd.
It is. A disciplined investor applying the cycle positioning step of ERT would look at a 100x PE for a hardware manufacturing company and instantly recognize a crowded top. The mathematical reality of sustaining the exponential growth required to justify that specific multiple was virtually impossible given the physical constraints of hardware deployment.
Sure.
So those who recognized this mathematical extreme avoided catastrophic losses when the stock inevitably collapsed.
Okay, I will grant you that a 100x multiple on a hardware company in the year 2000 was a clear anomaly. But identifying historical anomaly in hindsight is easy. How does the system operate in real time across a broad market?
That brings us directly to step 2, which is extreme scanning. This is the engine of the framework. We score assets across 4 distinct dimensions to build a comprehensive picture.
What are the dimensions?
We look at industry bubble signals, macro indicators, liquidity conditions, and sentiment readings. We grade this on a strict 20-point scale. A score of 16 or higher flags a mathematically extreme state. Consider Meta in 2022.
Let's break down what happened with Meta, because that is a really fascinating test case.
It is. The valuation and sentiment scores for Meta hit extreme levels on this matrix simultaneously. Why? Well, the company was pivoting massively into virtual reality, the metaverse.
Right, the rebranding.
Yeah. As a result, their capital expenditures were skyrocketing, burning through billions of dollars in free cash flow. At the exact same time, macro liquidity was rapidly tightening due to aggressive interest rate hikes from the Federal Reserve.
A brutal combination.
And sentiment reached a point of universal skepticism mixed with these high structural costs. The ERT system flagged it. It triggered a score above 16, foreshadowing its exact 75% decline.
Wait, hold on. Let me stop you right there on the execution of step 2. Assigning a rigid 20-point scale assumes that the weighting of these 4 dimensions is somehow constant over time.
It assumes they are all highly relevant, yes.
But in the case of Meta in 2022, you mentioned the macro indicator, specifically the unprecedented velocity of the Federal Reserve's rate hikes. I would argue that single factor was carrying the weight of the entire score.
I wouldn't go that far.
I would. A company-specific industry bubble signal, like Meta's metaverse spending, might matter immensely in a low-rate, highly liquid environment. But in a rapidly tightening liquidity environment, macro eclipses absolutely everything else. Your checklist treats these variables as equal contributors to a sum, whereas real markets often function through total domination by a single emergent variable.
But that is precisely why the framework requires all 4 dimensions to be evaluated concurrently. A single variable domination, like a massive spike in interest rates, will still push the aggregate score higher if the other variables, like sentiment and valuation, confirm the vulnerability.
But it skews the math.
It's a confluence of evidence. It's not about one variable being more important. It is about the structural integrity of the asset falling across multiple load-bearing pillars at once.
I understand the theory of confluence, but let's look at step 3, catalyst evaluation, because this is where rigid systems often substitute narrative for mechanics.
Well, recognizing an extreme is not enough. Identifying the triggers for reversals is crucial. You can have a room full of gasoline, but you still need a spark.
Okay, what's your spark?
The 2008 subprime crisis was definitively catalyzed by Lehman Brothers' collapse. The system was already incredibly fragile, the crowded top was established and mapped, but Lehman was the clear systemic inflection point that triggered the violent reversal. Those who systematically mapped counterparty risk recognized Lehman as the definitive catalyst.
Recognizing Lehman Brothers as a catalyst in hindsight is very different from systematically predicting its collapse as the definitive trigger beforehand. Let's look at the actual timeline of 2008.
Okay, sure.
Bear Stearns collapsed months earlier, right? In March of 2008. The Federal Reserve facilitated the sale to J.P. Morgan, and the broader equity market absorbed this shock and actually rallied for a brief period.
True, there was a relief rally.
And then Countrywide Financial, the largest subprime mortgage lender, deteriorated and was acquired by Bank of America. Again, the market absorbed it. If your system was scanning for catalysts, Bear Stearns looked exactly like a catalyst. Countrywide looked like a catalyst. Why didn't the system trigger the ultimate reversal signal then?
Because the fire brakes held.
But my point is that catalyst evaluation often devolves into post hoc narrative fitting. We find the event that preceded the largest drop and retroactively label it the catalyst.
It is not about narrative fitting. It is about recognizing when the structural fire brakes fail. Bear Stearns was contained by intervention. Lehman was allowed to burn. And that lack of intervention was the specific catalyst that forced the immediate repricing of all counterparty risk globally.
So the system is just guessing when the government steps back.
Though, the system flags the vulnerability. The extreme scanning tells you the system is leveraged to the breaking point, and the catalyst is the moment the market realizes the fire brakes are gone.
But the system didn't predict the government would let Lehman fail. That was a discretionary political decision made over a weekend. You cannot code the political calculus of a Treasury Secretary into a 20-point scale.
You don't need to code the political calculus if your strategy construction is properly aligned. Which brings me to step 4, strategy construction. Once you have positioned the cycle, scanned for extremes, and evaluated the catalyst potential, you tailor your strategy mechanically.
Mechanically?
Yes. The system dictates specific actions for specific phases. You don't just sell everything to cash and hide under a desk. You adapt your exposure.
Let's unpack the mechanics of that for a moment, because it sounds simple, but the actual implementation requires specific financial engineering.
Absolutely. Let's say the system flags a crowded top. You don't just short the market, which exposes you to infinite risk if the bubble expands further. Instead, you utilize covered calls. Let me explain how that works mechanically.
Please do.
You own the underlying stock, but you sell someone else the call option, to buy that stock from you at a higher price by a certain date. Because you are at a crowded top, implied volatility is usually very high, meaning the premiums you collect for selling those options are incredibly lucrative.
So you're harvesting volatility.
Exactly. You are harvesting premium when volatility is high, mathematically capping your upside, but generating cash flow while you wait for the reversal.
Okay, and what about the opposite end of the cycle, the valley of despair?
Conversely, you buy long-term equity anticipation securities, or LEAPs, in the valleys of despair. A LEAP is simply a call option with an expiration date further out than 1 year.
Why use leaps at the bottom, though?
Because in a valley of despair, the asset price is crushed and pessimism is absolute. By buying deep in-the-money leaps, you gain exposure to the eventual recovery uptrend while putting a fraction of the capital at risk compared to buying the stock outright.
So it's defined risk.
Yes, if the asset falls further, your maximum loss is strictly limited to the premium paid. Take the Netflix 2022 recovery uptrend as a perfect case study.
Netflix is a great example of narrative exhaustion. They announced their first subscriber loss in a decade, and the market reacted as if the entire streaming business model was permanently broken.
Exactly. The narrative drove the stock into a deep valley of despair. But the ERT system, looking objectively at the cash flow generation, the content library value, and the stabilization of churn, indicated an extreme oversold condition.
The math said buy.
The 20-point scale flashed a screaming buy signal. Investors who scaled in during that valley using the strategy construction guidelines, buying leaps to strictly limit their downside risk, while capturing the massive upside, were massively rewarded when the stock rallied over the next 18 months.
Al acknowledged the elegance of the strategy construction. Using options to define risk is prudent. But it all hinges on step 5, risk management. And this is where I see a significant vulnerability in the framework itself.
Well, the core tenet of step 5 is recognizing a fundamental market truth. Great companies can be terrible trades when the risk-to-reward ratio is distorted by valuation. Intel's 2024 valuation collapse underscores this perfectly.
How so?
Intel possesses immense strategic value. It has heavy government backing through the CHIPS Act. It is deeply embedded in global supply chains. But the fundamental capital expenditure requirements to compete in foundry economics, combined with their competitive positioning against fabless designers like NVIDIA and AMD, made it a terrible trade despite the pervasive great American company narrative.
So the system ignored the story?
The system manages risk by ignoring the narrative and focusing strictly on the math of the valuation extreme.
The difficulty is that distinguishing between a great company and a terrible trade requires a level of forward-looking qualitative fundamental analysis that a simple extreme scanning checklist often glosses over.
I don't think it glosses over it at all.
It does. Intel's 2024 collapse was not just a standard mean reversion cycle of a stock getting a little too expensive. It was deeply tied to a profound architectural shift in how computing is processed. The shift from central processing units to graphics processing units for AI workloads.
Which impacted their cash flow, which the system catches.
But a backward-looking quantitative system struggles to price in a paradigm shift where the fundamental utility of the company's core product is being structurally marginalized.
But the quantitative backing for this framework is incredibly robust across decades of data. We can look directly at Campbell and Schiller's 2001 research on valuation ratios.
The CAPE ratio research.
Yes. They definitively proved, mathematically, that high price-to-earnings ratios tend to precede lower long-run returns. It is a fundamental law of financial gravity. This completely validates the framework's core focus on identifying and respecting extremes. The math is undeniable. The psychological difficulty of executing this framework, however, is immense.
Well, yeah, because you were fighting human nature.
Precisely. It is incredibly hard to step away from a crowded trade like Cisco in 2000, when your peers are doubling their wealth every 6 months, when the financial media is mocking anyone urging caution. The discipline required to look at a 20-point scale and actively choose capital preservation over speculative participation is agonizing.
It's social suicide in a bull market.
And it really is. But that discipline is exactly what separates enduring multi-generational wealth from fleeting gains. The system provides the psychological anchor necessary to survive our own cognitive biases.
That is a compelling framing, I'll admit. But I come at it from a very different way. The psychological anchor you just described is actually a straitjacket. It blinds you to structural reality.
A straitjacket?
Yes. Let's transition to the profound limits of this system. Because when you introduce real-world data, it absolutely destroys these static parameters. Your first major flaw is that extremes are fundamentally unstable. What constitutes an extreme is entirely context-dependent, and it shifts radically across different macroeconomic regimes.
How so? A multiple of 100 is a multiple of 100. The math doesn't change.
The math doesn't change, but the asset being measured does. You cited Cisco in the NASDAQ 100 in March 2000, noting the trailing PE of roughly 100x as a clear, undeniable extreme.
Yes, which it was.
But let's track the NASDAQ 100's trailing PE over time to see how this anchor actually functions. It was indeed approximately 100x in March 2000. Now fast forward to November 2021 at the absolute peak of another massive historic bull market. The trailing PE of the NASDAQ 100 was roughly 40x. And in May 2024, it sat around 32x.
I see where you're going with this.
If your rigid system defines 100x as the extreme threshold based on the 2000 baseline, you would have never, ever generated a sell signal in November 2021 before the brutal 22 bear market.
Well,
You would have written the entire crash down while your system told you everything was fine. Conversely, if you manually adjusted your threshold down to 40x to catch the 2021 peak, you are admitting the system is entirely subjective. You have the exact same metrics, but entirely different outcomes across regimes.
But that ignores the composition of the index.
Exactly my point. The structural composition of the Nasdaq changed fundamentally. In 2000, it was dominated by low-margin hardware companies and internet portals with zero revenue.
Right.
By 2021, it was dominated by high-margin, recurring revenue, sticky software monopolies. A 40x multiple on a software company with 90% gross margins and immense pricing power is fundamentally mathematically different from a 40x multiple on a router manufacturer in a highly commoditized market.
But
the very definition of what constitutes an extreme mutated because the underlying economic structure evolved. Your static ruler failed.
the framework absolutely accounts for changes in underlying fundamentals. The 20-point scale measures extremes relative to the prevailing conditions, not against a static historical number carved in stone. We measure the valuation relative to the growth rate and the margin profile of the specific era.
If the scale changes relative to prevailing conditions and requires a human to decide what those conditions warrant, it is no longer a rigid system. It is a discretionary framework masquerading as objective math.
I wouldn't call it masquerading.
I would. But let's move to the second fatal flaw. Catalysts are emergent. You framed Lehman Brothers earlier as a neat, perfectly identifiable catalyst. But real-world catalysts are black swans. They are complex, multi-causal events that absolutely no scanning methodology can capture. Consider the COVID-19 pandemic.
A literal act of nature.
Yes. It triggered a devastating 19.6% drop in the S&P 500 in the first quarter of 2020. I challenge you to explain how a 20-point scale analyzing macroeconomic indicators or industry bubble signals could have predicted a novel coronavirus jumping species in Wuhan and subsequently shutting down the entire global economy.
It couldn't.
Exactly. It is impossible. Or look at the ever-given Suez Canal blockage in 2021.
The container ship that got stuck.
Exactly. This was a tiny, hyper-localized trigger, a single ship stuck in the mud due to high winds and a navigation error. But because the global ecosystem was optimized for just-in-time delivery, that single localized event caused massive, cascading effects through global supply chains.
It was a massive disruption, true.
It created a bullwhip effect that severely exacerbated global inflation dynamics, altering the course of central bank policy. You cannot systemize the unpredictable. No model factors in a ship getting stuck sideways in a canal.
That is a fundamental misunderstanding of what the system is designed to do. A system does not need to predict the exact nature of the black swan. I do not need a model that predicts a pandemic or a stuck cargo ship.
Then what is it predicting?
The system needs to identify the vulnerability of the market to any external shock. If the extreme scanning metrics show that the market is at a crowded top, completely fully invested, with peak leverage and perfect sentiment, it is highly vulnerable to whatever the catalyst turns out to be.
But the catalyst timing is what matters.
It could be a central bank policy error, it could be a geopolitical conflict, or it could be a pandemic. The specific catalyst is irrelevant. The structural vulnerability is what ERT measures.
But that defense leads us directly into the third major flaw. Historical models decay over time. The backtests that give you this immense confidence, the backtests that prove your system works, are built on data that no longer reflects the reality of the financial plumbing.
The data is robust.
You cited Shiller's 2001 research on price-to-earnings ratios. That research was incredibly valuable, but it was built on decades of data where the cost of capital was structurally much higher.
Interest rates change, yes.
But they didn't just change, they entered a different dimension. Let's look at the average U.S. federal funds rate. It was roughly 9.9% in the 1980s. When money costs 10% risk-free, equity multiples must naturally be very low to attract capital.
Right.
Now contrast that with an average of approximately 0.1% from 2009 to 2015, and again in 2020 to 2021. High liquidity, mathematically driven by central banks, fundamentally alters what an extreme is.
Walk the listener through the exact math of why that invalidates the historical baseline.
Gladly. The value of any financial asset is the present value of its future cash flows discounted back to today. The discount rate you use is heavily influenced by the risk-free rate, the federal funds rate.
Okay.
If the risk-free rate drops from 9.9% down to 0.1%, the denominator in your valuation equation shrinks massively. Therefore, the present value explodes upward. When the risk-free rate is 0, the mathematical justification for equity multiples expands dramatically.
I see the point you're making.
Models built on pre-quantitative easing data fail catastrophically in a high-liquidity environment because the discount rate mechanism has been completely manipulated by central banks. Your historical baseline is built on a gravity that no longer exists.
That is a very strong argument regarding the discount rate. I'll concede that. But does model decay mean we throw out the entire framework? Or does it simply mean we must recalibrate the parameters of our 20-point scale?
I think it invalidates the rigidity.
A broken clock requires fixing, not a wholesale rejection of the concept of time. If the federal funds rate averages 0.1% for a decade, we actively adjust the baseline for the macro indicator dimension within the system.
So you tweak the dials.
We do. The underlying logic, the core premise that human emotion drives markets to extremes, and those extremes eventually self-correct and revert, remains perfectly intact. We just update the math to reflect the new cost of capital. We adjust the denominator.
You keep trying to adjust the machine, but you are treating this like a clockwork mechanism. To really understand the reality of unpredictable chaos, we need to reframe how market behavior actually functions in the wild. The most accurate analogy is viewing markets as ecosystems.
An ecosystem rather than a machine.
Exactly. Markets possess nonlinear responses and complex thresholds that completely defy rigid, predictable categorization. Think of a biological ecosystem, like a rainforest or a coral reef.
Okay.
You can introduce a single new species or experience a slight change in ocean temperature, and the entire food web collapses or restructures in ways no biologist could map on a 20-point scale. Emergent properties take over.
But ecosystems have carrying capacities.
Yes, but a checklist assumes a linear relationship. High valuation plus bad sentiment equals an immediate reversal. An ecosystem assumes that high valuation might sustain itself indefinitely until a completely unmapped variable alters the carrying capacity.
Give me an example of an unmapped variable altering the carrying capacity.
The shift in market structure from active to passive investing. Trillions of dollars move from discretionary fund managers who care about valuations to algorithmic index funds that indiscriminately buy every stock in the index regardless of price, simply because capital flowed into the fund.
The passive flow dynamic.
Yes, that entirely changed the carrying capacity of market multiples. A linear checklist cannot capture that structural shift.
I accept the ecosystem analogy, but I think you are drawing the wrong conclusion from it. Even complex ecosystems have physical and mathematical boundaries. A forest cannot sustain an infinite population of predators.
Eventually, the prey runs out.
Right. Eventually, the prey is exhausted, and starvation initiates a cyclical reversal. The population crashes. The ERT system is not trying to map every leaf in the forest. It is simply measuring the ratio of predators to prey. It is measuring the boundaries of the system.
But how do you evaluate the catalysts in this ecosystem? You have argued that ERT objectively evaluates catalysts. I view ERT like a detective in a film noir relying solely on forensic evidence.
Well, forensic evidence solves the crime.
It solves the mechanics of the crime, but it misses the plot. Your system looks at the fingerprints, the angle of the bullet, the blood splatter. It looks at the PE ratio, the moving averages, the liquidity metrics.
Which is objective reality.
But by relying entirely on the sterile quantitative forensic data, you miss the dark, twisted psychological motivations driving the narrative. Catalysts are just symptoms of deeper structural shifts. They are not the clean causal drivers that systems want them to be.
So you're saying psychology is the true driver?
Yes, the murder does not happen because the gun is loaded. The murder happens because of greed, fear, or revenge. In markets, the reversal does not happen just because the PE hit 40x. It happens because the narrative utility of the asset has been completely exhausted in the minds of the allocator.
That is a brilliant narrative framing, the detective in the film noir. But let me push back on that, because Forensic evidence still places you at the scene of the crime before the explosion happens.
How?
If I'm the detective and my forensic system tells me that a room is rapidly filling with gasoline vapor, I do not need to know the psychological motivation of the person standing outside holding the match.
Okay, fair.
I do not care if they are motivated by greed, fear, or if it is just an accident. I just need to know that the room is highly combustible and I need to instruct my clients to leave the building immediately.
You just get out of the room.
Yes, the extreme reversal theory measures the volume of gasoline in the room. You are demanding that we predict exactly who strikes the match and when, which I agree is entirely impossible. But measuring the gasoline is not just possible, it is imperative.
The problem with measuring the gasoline is that markets are fractal. What appears as an extreme, table-pounding reversal on a daily chart, a massive spike in volatility that triggers all your alarms, might just be standard, irrelevant statistical noise on a weekly or monthly chart.
It depends on your time frame.
Exactly. Extremes are inherently scale-dependent. If you are applying a quantitative checklist to a daily timescale, you will generate constant false positive signals of extremes. You will be selling out of positions constantly.
You'd get whipsawed.
Right. The market is self-similar across different timeframes, making it incredibly difficult to systematize exactly which timeframe is the definitive arbiter of a cycle phase. A crowded top for a high-frequency day trader is nothing more than a minor buying opportunity on a dip for a multi-decade pension fund. Whose cycle are you actually positioning for?
You position for the cycle that aligns with your specific capital mandate. If you are a pension fund, you apply the ERT parameters to a multi-year horizon. If you are a swing trader, you apply it to a quarterly horizon.
But it requires subjective alignment.
It does. But I think this entire back and forth, the machine versus the ecosystem, the forensics versus the psychology, leads us to a crucial realization. The strict binary of system versus chaos is fundamentally flawed.
I think we're finally getting somewhere.
We have rigorously debated the deterministic nature of the five-step ERT model. But I believe the synthesis of our two views actually provides the most workable, powerful approach for a modern allocator.
I agree entirely. We must move toward a synthesis. If we are being intellectually honest, the extreme reversal theory fails as a deterministic turning point predictor.
It won't be perfect.
It will not ring a bell at the exact top, and it will not ring a bell at the exact bottom. But it succeeds powerfully if we reframe it as a probabilistic, regime-aware risk framework. The entire goal of the allocator must shift away from the hubris of predicting the exact reversal and move entirely toward estimating reversal vulnerability.
Yes, it is about asymmetry. So, let's meticulously detail the practical implications of the synthesis for anyone trying to apply this in real time. We have identified 7 precise adjustments that transition this framework from a rigid, fragile checklist to a highly dynamic risk engine.
Let's walk through them. What is the first major adjustment?
The first implication is that we must adapt our thresholds dynamically. We abandon the static historical bands.
So no more hard 100x PE rules.
Right. Instead of looking at Shiller's data and saying a 100x PE or a 30x PE is the universal extreme across all of time, we dynamically adjust our valuation thresholds based on prevailing interest rates and liquidity conditions. If central banks are actively expanding their balance sheets and printing money, the threshold for what constitutes an extreme valuation automatically scales upward to reflect the new mathematical reality of the discount rate.
That makes the system viable in modern regimes. The second practical implication is that we must model nonlinearly explicitly.
Which means what, practically?
We have to stop relying on point forecasts. For instance, confidently declaring the S&P 500 will hit exactly 5,200 by year-end based on a reversion to the mean. Instead, we must use scenario trees to map out catalyst pathways.
How does a scenario tree work in practice?
You map out multiple divergent futures based on emergent variables. Branch A might be inflation re-accelerating. Branch B might be a sudden deflationary shock. Branch C is a geopolitical escalation.
And you weight them.
Exactly. You assign probabilities to each branch of the tree based on current data, rather than betting your entire portfolio on a single deterministic outcome. You are modeling the chaos rather than ignoring it.
Which leads perfectly into the third implication. We must stress test implementation lag. This is critical. Even if your dynamic system correctly identifies that the market is highly vulnerable, emergent catalysts like the Ever Given or COVID-19 move at the speed of light.
Faster than you can trade, sometimes.
Exactly. Strategies must account for the mechanical latency in reacting to these fast-moving events.
Put the listener in the shoes of a fund manager experiencing that lag.
Well, imagine you are managing a $2 billion portfolio. Your system flashes red on a Tuesday, but you hold massive, illiquid positions in small-cap biotech or emerging market debt.
You're trapped.
You physically cannot sell all of it in one afternoon without crashing the price of the asset yourself. It might require 3 to 5 days of careful algorithmic trading to unwind the position. If a black swan catalyst craters the price by 20% on Wednesday, your system was right, but your portfolio is still destroyed. Your framework must mathematically factor in the damage sustained during that implementation lag.
Fourth, and this touches on the limitations of purely financial data, we must integrate geopolitical context. Historically, quantitative systematic frameworks treat geopolitics as a qualitative afterthought.
It's hard to put a number on geopolitics.
It is, but it's not something just for the talking heads on financial television to discuss. We must elevate structural and geopolitical risks to a primary dimension of the extreme scanning process, equal in weight to market internals. A perfect corporate balance sheet, incredible cash flow, and low valuation mean absolutely nothing if a critical semiconductor supply chain is suddenly severed by state-level military conflict.
Absolutely. The fifth implication demands a massive shift in how we judge ourselves. We must evaluate decision quality, not just timing.
This is vital to surviving the psychological toll of the markets.
Exactly. Success within this synthesized framework must be measured by improved positioning, mathematically accurate position sizing, disciplined hedging strategies, and cold mechanical entry mechanics.
You can't beat yourself up for missing the top tick.
No. If the framework forces you to reduce leverage and keeps you out of the worst 80% of a brutal drawdown, but you miss the absolute bottom by a few weeks and leave some money on the table, that is a profound success of decision quality. We cannot judge the system solely by its ability to perfectly call the very top tick and the very bottom tick.
Sixth, and I believe this is perhaps the most critical update for modern markets, we must monitor algorithmic trading volumes. We are no longer trading exclusively against human psychology.
The machines have taken over.
They really have. The days of just outsmarting the fear and greed of retail investors are over. We must incorporate real-time data on systematic trend-following algorithms, commodity trading advisors, options dealer hedging flows, and the sheer volume of 0 days to expiration options.
The mechanical flows.
Yes. These non-fundamental, purely mechanical forces often drive the market to extremes that completely defy traditional valuation metrics. If an options dealer is forced to continuously buy a rising stock to hedge the calls they sold, they do not care about the PE ratio. They just execute the hedge. Ignoring the structural market plumbing is absolutely fatal for any modern framework.
Finally, the seventh implication, focus on vulnerability, not prediction. This is the ultimate synthesis of our debate. We use the extreme reversal theory to identify when reversal risk is mathematically underpriced by the options market and the broader consensus.
Finding the asymmetry.
We are looking for asymmetry. We are looking for moments where the downside risk is massive, but the market is pricing options as if the downside risk is zero. We seek asymmetry, not certainty. Now, having laid out those 7 points, I must point out the beautiful irony here.
What is the irony?
These 7 implications, dynamic thresholds, scenario trees, implementation lag, geopolitics, decision quality, algorithmic flows, and vulnerability mapping are in themselves a highly structured system.
Ah, I see what you're doing.
By agreeing to adapt thresholds dynamically, by explicitly modeling scenario trees, and by systematically integrating new data like algorithmic dealer volume, you are actually validating my core premise. Discipline and frameworks survive. They do not die in the face of emergent complexity. They simply evolve to encompass it. You haven't destroyed the system, you just helped me build a better one.
It is a system, yes, I will grant you that. But it is a system completely stripped of its initial hubris. It is a framework that embraces uncertainty as a core feature of the architecture, rather than trying to banish it with a 20-point checklist. It acknowledges that the market is a living, breathing, mutating ecosystem, not a clockwork mechanism that can be perfectly timed.
As we reflect on the journey from the rigid, historical five-step extreme reversal theory to the highly nuanced, regime-aware framework we have synthesized over the past hour, the profound value of rigorous intellectual debate becomes incredibly clear. We began with a sharp disagreement over whether a deterministic checklist could possibly tame market chaos.
And we should fully acknowledge our continued disagreement on exactly how much weight to give historical backtesting versus the constant threat of emergent, unprecedented risks. I will always view historical financial data with deep, profound skepticism in a market driven by novel algorithmic structures, passive flows, and constantly shifting monetary regimes.
While I will maintain that human nature, our innate propensity for crippling fear and irrational greed, is the one absolute constant in financial history, and historical backtests capture the physical reality of that psychological pendulum perfectly, but our convergence on a probabilistic, vulnerability-focused approach provides an incredibly powerful tool for navigating the violent volatility ahead. We leave the listener to examine their own analytical frameworks. Are you relying on static rules in a highly dynamic world? Or are you operating entirely on raw intuition without any structural anchor to save you from your own biases? There is vast material here left to explore, particularly regarding how individual asset classes, from commodities to sovereign debt, respond uniquely to these dynamic thresholds.
The core takeaway for anyone managing capital is a recognition of the limits of our models and a deeper understanding of the true mechanics of market inflection points. Markets don't reverse when conditions are extreme. They reverse when narratives, liquidity, and constraints stop tolerating the extreme.
This is the Research Desk officially signing off.